Hello, it's Adil bringing you a review of the FTSE 100 from an intermarket analysis perspective. It's Wednesday the 9th of July 2014. Okay, so interesting week thus far, interesting week last week. Okay, even in the face of a rising sterling, the FTSE failed to sell off and was consistently floating higher on the back of, I don't know, you can call central bank stimulus, central bank Kool-Aid, intervention, call it what you want. Okay, basically the markets were short squeezing higher. You can even blame it on the light volume Independence Day in the US, or you could blame it on the Mr. Draghi short squeeze. Okay, blame it on whatever you want. Okay, well basically the markets obviously short squeezed higher, went into resistance, and now as you can see gave back the whole rally. So where are we now? We're back to square one, back to ground zero. Okay, so interesting. Very hard to make things of it. Last week I attempted to short the market, and I was burnt a few times. Last week was a break-even week. This week so far plus 10 points at the moment, but still very tricky to read, because obviously I gave credence to the fact that and yesterday I initially started off shorting the market, then I actually bought the dip on anticipation of at least 60% or 50% of the rally holding from last week, and that's not been the case. We've given back almost 100%, if not more, after hours, because the FTSE fell as low as 6, 7, 10 regions. So impressive price action. I mean, how do you read this market? Okay, so if you look at it from this perspective here, you've put in a double top, you've got lower lows, lower highs, and you expect the markets to go lower. What happens? The markets break out last week, and with the US markets obviously leading the way, and Mr. Draghi's short squeeze, etc., etc. Light volume, call it whatever you want. We broke this bearish channel. Once you break a bearish channel, the market is expected to retest the breakout and then obviously continue to thrust higher, and that's not been the case. So last week, even with a weaker sterling, stronger sterling, the market still continued to short squeeze higher. So it's a real conundrum right now trying to read these markets. Very hard to read. As you can see here, double top, triple top, bias change principle, lower lows, lower highs, and all of a sudden bang, off we go to the races again, and then obviously we give back almost 100% of that rally last week. How on earth do you read that market? If there's anybody else out there that's reading this market very well, hats off to you. I, for one, certainly can't. The last 2 or 3 weeks have been very confusing. That usually happens. There's a lot of traders out there, even on my live analysis service, that are confused as to why I'm not performing as good. And one glance at this chart will explain why. We use our technical art of TA, and TA states that once the market puts in a triple top, flat tops equal market drops, and then you look for a potential bias change to short the market, and that obviously hasn't been the case. As you can see here, lower lows, lower highs, and then powerful reversal, and then all of a sudden we give back 100% of the whole rally. So how on earth, you just chop? Okay, a lot of confusion, a lot of misunderstanding. Obviously, if Mr. Draghi is doing the ABS and he's doing his version of QE, then that should have technically held the markets higher, and that's not been the case for Europe or the UK. But whereas the US markets are diverging and Asian markets are flat and going sideways, so there's a lot of divergences out there. I mean, the Aussie and Kiwi remain strong, and yet the FTSE gives back 100% of the rally, whilst Aussie and Kiwi hold the rally. So I mean, I can go on. There's a lot of divergences right now, but again, that's primarily due to central banks. Okay, I remember when QE1 and QE2 and QE3 was obviously put into effect. Even when the BOJ started their easing, this is exactly what happened. The markets were totally distorted, moving up and down, and individuals positioning, trying to interpret central bank activity. It usually takes at least 2 to 3 weeks post a central bank. And then obviously the markets return back to some sort of normality. Because last week the markets were rallying on bad data. We had weak unemployment data out of Germany last week. And yet the markets rallied. And this week we've had weak data and the markets are sold off. So the markets need to make their minds up whether they're going to rally on good news or they're going to rally on bad news. So it's all about what the market interprets. Okay, so now the euro obviously remains stagnant. It's not going lower, even though Mr. Draghi has dangled the QE carrot. And the FTSE, like I said last week, was rallying in the face of sterling breaking 1.7, which obviously hurts exports. And that's obviously transpired with the latest batch of economic data that was released out of the UK yesterday. As we can see, sterling's obviously hurting exports, And the same thing with regards to Germany. Obviously, German data I was very weak, so that must show that the euro obviously is crimping exports because their imports certainly dropped as well. So how do we interpret that? Okay, we just have to adhere to our strategy, adhere to our trading plan. Okay, keep your stop losses intact, maintain and adhere to your stop losses at all times. Okay, and remain steadfast, remain patient, and you must realise that 1 or 2 weeks as a bad trader doesn't mean anything. Last week was a break-even week. The week before that, I think it was minus 150. The week before that, I think it was minus 100 or minus 180. And then the week before that was 370 plus 370 points. So it's irrelevant for me because I've been doing this for almost 10 years now and nailing in excess of 200 points on average per week, around 1,000 points a month for the last 10 years. So for me, you have bad periods in trading. Remember, there's 56 weeks in a year, okay, and you can't be successful on every single week, okay. I understand that subscribers have been with me this week or the last 2 or 3 weeks, and my performance hasn't been obviously plus 200 a week. Has been poor, certainly according to my standards, but that's the market, folks. You have to realise you take the good with the bad and the bad with the good, and you must always adhere to your stop losses. So last week was a very poor week. Break-even week for me is a poor week, I can assure you. So this week so far I'm plus 10 points, I think, if I can remember correctly, and we'll see exactly what today brings. So it's a challenge, okay. It's always a challenge, but that's what we as day traders we thrive on, okay. And it's the volatility that we love, and it's the ability to navigate the markets correctly. So as long as we always go back to the drawing board, reanalyze, refocus, realign ourselves with all the variables in the markets, and then obviously we can adjust accordingly. So let's try and fathom, and let's try and understand exactly what's going on with regards to the FTSE 100, okay. So what are the bearish variables right now for the FTSE? Bearish variables right now, obviously sterling above 1.7. That's certainly a bearish variable. That's hurting exports. Weak economic data yesterday, but both those variables certainly can be argued at this very juncture are now factored in, with the FTSE obviously falling from the high at 6,880 all the way down to 6,730. That's a 150 point drop. So that's certainly factored in all the bearish news. So what's left now is the bullish news, okay. So what is the bullish news that can trigger a short squeeze on this FTSE? Number one, Alcoa results, okay. Alcoa results better than expected certainly helps the FTSE 100 because obviously it's commodity related, okay. Chinese inflation data came in lower than expected overnight, which increases the probability of stimulus. So again, that should propel and create a short squeeze in the FTSE because once China attempts any sign of central bank intervention or stimulus, that helps the commodity market, so it helps demand for commodities. That in turn obviously supports the commodities and helps the FTSE 100 rally, okay. So that's generally bullish, okay, and that's why Aussie and Kiwi are remaining afloat and remain strong, okay. So that's one of the reasons why there's a divergence between the FTSE and the Aussie and the Kiwi in the last 24 to 48 hours, okay. So that's certainly signalling to me that the FTSE wants to rally. So I'll be a buyer of the FTSE from the outset this morning with subscribers on the live analysis service, okay. So and given the fact that Asian markets haven't sold off as much, as in proportion to the US markets, the Nikkei is only down by 70 points and the Shanghai is only down by -7. So again, that tells you that the lower inflation data certainly has put a bit of base into the Asian markets, and Kiwi obviously and Aussie are certainly into support, and the yen pairs certainly are holding support as well. So all those variables put together certainly indicate support, okay. So let's have a look at the actual chart now, daily chart. So daily chart of the FTSE 100 is into horizontal support, okay. The FTSE 250, if you just observe that as well, let's go into the FTSE 250. Okay, FTSE 250, as we can see, we are into 61.8% retracement pullback. So we certainly are looking at a potential reversal here. And also, what other pattern do you notice from my perspective? What do I notice here is I notice an inverted head and shoulders formation. So on the actual FTSE 250. Now this is based on the premise, okay, just bear this in mind, this is based on the premise that the economic data that came in yesterday was weaker than expected. That obviously reduces the probability of a rate hike. If that reduces the probability of the rate hike, that will obviously cause sterling to go lower. Sterling goes lower, helps export sector, and obviously the markets then recover quite powerfully, and then obviously we trigger off this inverted head and shoulders. Okay, so just keep an eye on that pattern. So I'd certainly be a bull on the FTSE from this juncture, and I'll certainly be buying the FTSE 100 from the outset this morning. Okay, so FTSE 250 inverted head and shoulders, obviously we're in the 61.8% retracement, so keep an eye out for that. Okay, FTSE 350, again we are into horizontal support, previous resistance equals support, so that's certainly a reason why the FTSE will certainly be looking to short squeeze higher this morning, especially with regards to Alcoa's results. Okay, 60-minute chart, as you can see, we are into support. We've broken the pivot S3, which again very rare that the markets break the S3 that powerfully, but horizontal support nevertheless. Okay, obviously we have lower lows, lower highs. The last candlestick there was a potential bottoming tail, and we'll see exactly what that brings. So we are looking for a potential reversal up to the 6750, 6760 area, and then we'll just take it from there. Given the fact that this market seems to constantly making lower lows and lower highs at the moment, so very, very interesting times. Okay, folks, so I think that sums it up for me now. I think with regards to the FTSE, I've given you my arguments as to why I think the FTSE is going to rise. Okay, come this morning, and I'll be a buyer. But can you see the conundrum, folks? Okay, with regards to price action. I mean, let me just give you an example from the German DAX. Another prime example of the German DAX. I mean, the German DAX, what happens with regards to German DAX? We put in a double top intraday. We're looking for a lower high. What happens? The market short squeezes higher, goes into that resistance zone, and then obviously gives back the whole move. How on earth are you supposed to read that? Okay, how on earth do you read that? Mr. Draghi did not allude to QE. Okay, all he alluded to was negative rates, and he set the framework for QE. Okay, and yet the markets were short squeezing higher on a light volume free week led by the US markets. So, and even in the face of weak economic data out of Germany. So, and then all of a sudden this week, once the light volume's out of the equation and the traders are back, they sell the living daylights out the German DAX. So it's a conundrum. Okay, it's a conundrum. How on earth do we pay respect to last week's price action and then obviously allow it to continue? Obviously, from my perspective, this week I expected that Mr. Draghi obviously would dangle the carrot. The carrot's been dangled. We have a bull flag, and obviously we break out on this bullish engulfing candle with regards to the green candle that was registered on last week. So that's not been the case with regards to obviously the Nasdaq moving higher, so therefore the German DAX follows, etc., etc., etc. Okay, so interesting times, folks. But for now, German DAX is into support. Previous resistance equals support. Hence the reason why I'll be buying the pop. Well, buying for a pop come tomorrow. Okay. So, well, come tomorrow, come today now, it's 6 AM, Wednesday. Okay, folks, so risk on, risk off, wax on, wax off. Goodbye now.